Stop. Before you hit sell on silver, zoom out. Everyone is celebrating record highs this week. Silver is ripping, headlines are screaming, and the loudest crowd on the internet is doing what the crowd always does at the wrong time, taking profits too early. My 2026 exit plan is simple and it's locked. I'm not selling silver until the gold-silver ratio hits 30.1, not 50.1, not 45.1, not it feels high. 30, because the ratio is the story, not the price. And if you understand the ratio, you realize something uncomfortable. Most people don't exit at the top. They exit in the middle of the move and then watch the real top happen without them. Quick note, this is not financial advice. I'm sharing my framework and the data I'm watching so you can build your own plan. Walked at the ratio reality check. As of Jan 23, 2026, the gold-silver ratio is around 51.3.1. That number matters because it's already a collapse compared to where we were. In early 2025, the ratio was hovering around 100.1. That was the silver is dead era. That was the era when the world treated silver like a cheap cousin of gold. Now the ratio is falling fast because silver is outperforming. And this is the trap. People see the ratio fall from 100 to 50 and think, well, that's it. We made it. No, that's the warm-up. Historically, for centuries, the ratio averaged near 16.1. Modern markets don't live there all the time because paper leverage and central bank behavior distort everything. But when silver finally goes parabolic, the ratio doesn't politely stop at 50. It dives. In 2011, when silver ran to about $49, the ratio pushed down near 31.1. In 1980, when silver went full blow-off, the ratio briefly approached the teens. So when people exit at 50.1, they're not selling the top, they're selling the beginning of the endgame. Think of 50.1 as the median zone. The market is saying, silver is finally being treated like it belongs in the same conversation as gold, but the true top behavior is different. The true top is the market screaming, we need silver more than we need gold. And that's when the ratio has the potential to hit 30.1. Now let's do the math everyone ignores. If gold holds around $4,800 to $5,000 per ounce and the ratio hits 30.1, silver has to mathematically price around $160 to $166 per ounce. That's not a prediction. That's arithmetic. So the question becomes, do you want to exit at 50.1 and hope you timed it? Or do you want to follow the one signal that has historically marked the final phase? My choice is clear. I'm waiting for 31 because that's the level where silver is finally expensive relative to gold. Why silver is outrunning gold in 2026. Here's what's happening right now and why it matters. In the first 3 weeks of 2026, silver is up roughly 20-25%. Gold, in that same window, is up around 6%. And zoom out one more layer. In 2025, silver returned roughly 145% versus gold's 64%. That gap is not a fluke. It's the nature of the silver market. Silver is smaller, it's thinner, it's more volatile. When capital rotates into it, the move is violent. It doesn't glide upward like gold, it slingshots. And here's the key. This outperformance phase is exactly what compresses the ratio. That's why I'm not looking at a single price print and calling it the top. I'm watching the relationship between the two metals because the ratio tells you when silver has gone from undervalued to properly valued to overvalued relative to gold. We are not at overvalued yet. At 51.1, we're still in the re-rating phase. That's why selling now is so dangerous. You're exiting while the market is still rewriting what silver is. The structural deficit. Why supply can't respond. Now let's talk about the part that makes this different from a normal bull run. Silver isn't just a precious metal anymore. It's being treated like a strategic industrial asset. In 2026, the world is waking up to the fact that silver is not optional in modern infrastructure, and supply cannot simply ramp. Around 70% of silver production is a byproduct of mining copper and zinc. That means you can't just flip a switch and produce more silver because the price is high. You have to open or expand base metal mines, and that takes years. So when demand rises fast, silver doesn't get a gentle price increase. It gets rationed through price. On the demand side, the solar machine keeps pulling ounces. Solar PV capacity is forecast around $665 in 2026, and panels alone can require over 120 million ounces of silver. And that's before you add AI data centers, high-performance electronics, electrification, grid upgrades, defense applications, medical uses. The list is long, and the substitution options are limited. Now add one more layer, the China factor. China has announced export restrictions for 2026 that tighten the flow of physical silver into Western markets. Even if the paper markets want to pretend supply is abundant, the physical bottlenecks don't care about paper narratives. This is why the ratio compression can accelerate. When physical metal becomes hard to source, silver's industrial role starts to overpower gold's safe haven role. Gold is the monetary anchor. Silver is the monetary anchor plus the industrial fuel. And in a world that is electrifying everything, the fuel matters. The 2026 catalysts: safe haven gold, industrial silver. Let's address the catalyst layer, because this is where people get confused. In 2026, geopolitical tension, Greenland, tariff threats, EU friction, trade route pressure pushed a safe haven bid into gold. That makes sense. Gold is where money hides when it's nervous. But silver's real engine isn't fear. Silver's engine is shortage. Fear can spike prices. Shortage can sustain them. So even if the headlines cool down, the industrial draw doesn't stop. Solar factories don't stop. Grid upgrades don't stop. Defense procurement doesn't stop. Data centers don't stop. This is why I treat gold as the front runner of the narrative and silver as the late stage accelerator. Gold lights the fuse. Silver is the rocket. And when the market finally admits silver is strategic, the ratio can fall faster than people expect. If major institutions and governments start classifying silver as critical for supply chain security, that changes positioning behavior. It stops being a hobby trade and starts being inventory. That's the shift from jewelry mindset to national security mindset. The true top signals I'm watching now. We get to the part that matters. How do you avoid exiting too early or too late? I'm watching 3 signals, not 1, 3. Weekly, RSI divergence. I don't care if silver makes a higher high on the chart. I care if it makes a higher high while momentum makes a lower high on the weekly relative strength index. That divergence is the market whispering, this move is losing internal energy. A blow-off top often looks like the strongest candle you've ever seen, right before it collapses. RSI divergence is your early warning. So if silver is vertical, and the weekly RSI fails to confirm, I get cautious. Open interest collapse during a vertical move. This is the paper market tell. When the COMEX open interest starts dropping hard while price is still rising, that means paper participants are fleeing. They're closing positions. They're unable or unwilling to maintain leverage. That's often what happens near a major top. The market can still push price up, but the structure underneath is cracking. If price is soaring and open interest is falling off a cliff, I don't celebrate. I tighten my plan. The 31 touch. This is the macro exit lever. I don't need a perfect price. I need the ratio to hit the zone that historically marks the final phase of silver manias. Because at 31, silver is no longer catching up. At 31, silver is leading. That's when I'm willing to rotate. And yes, I said rotate. I'm not selling to cash, I'm swapping the ratio. Here's the move most people never learn. My plan is not sell silver, sit in cash, hope I buy back lower. My plan is use the ratio like a lever. When silver is cheap relative to gold, like 80.1, 91, 101, you accumulate silver. When silver becomes expensive relative to gold, like 31, you trade silver for gold. Why? Because the ratio is mean reverting over time. Here's the cycle. Silver mania compresses the ratio. Recession or liquidity crunch expands the ratio. You swap at extremes, not at headlines. So if the ratio compresses to 30.1 and later blows back out to 80.1 during a recession, you can potentially swap your gold back into significantly more silver than you started with. That's the long game. That's the chess move. Most people play checkers with a sell button. I'm playing the ratio. The premature exit trap, why people sell right before the move. Let me tell you why so many people exit early. They anchor to their entry price. They anchor to round numbers. They anchor to fear. They see a big weekly gain and think, this is too good to be true. But parabolic phases don't feel safe. They feel stupid. They feel like you're late. They feel like the world is joking. And then the world realizes it's not a joke. That's why I have a rule. I don't exit because I'm excited. I exit because my signals trigger. So if you're watching this and you're tempted to sell because silver outperformed gold by 12% this week, I want you to ask yourself a harsher question. Are you exiting because the move is over, or because you can't emotionally tolerate the volatility? Because volatility is the admission price for outsized gains in silver, and 2026 is built for volatility. My battle plan for 2026. Here's exactly what I'm doing from here. I track the gold-silver ratio weekly, not daily, weekly. I watch for weekly RSI divergence when price starts going vertical. I monitor COMEX open interest behavior during spikes. I ignore day-to-day drama unless it changes the supply story. I don't sell at 51 because that is still the mid-race zone. My rotation trigger zone is 33.1 to 28.1, with 30.1 as the bullseye, and when that zone hits, I don't panic sell. I execute a swap, silver out, gold in. Then I wait, because the next phase after mania is always reset, and that reset is where the ratio opens back up and the lever works in reverse. The line in the sand. If you take one thing from this video, take this. Price is noisy. The ratio is truth. At 51.1, this move is not done, it is evolving. So no, I'm not selling silver because it had a hot week. I'm not selling because someone on social media says top. I'm not selling because I'm scared of giving back gains. I'm selling when the market itself tells me silver is expensive relative to gold, 30-1. If you want, drop a comment with your own ratio target, 31, 25-1, 16-1, and tell me what signals you're watching. But it's just enough. So why my target is 31 and not 16-1? Some people will hear historical average 16-1 and say, then why not wait for 16-1? Because I'm not trying to be a hero. I'm trying to be consistent. 16-1 is the ancient anchor, but modern markets are built on leverage, derivatives, and interventions. Silver can absolutely overshoot towards 16.1 in a true panic, but it can also peak higher than that and still be a generational top. So 30.1 is my realistic extreme target. It's the zone that has shown up in modern peaks, and it's the zone where the risk-reward flips. Think of it like this. 50.1 is the midpoint where silver finally gets respect. 41 is the crowd noticing the move. 35.1 is the crowd piling in. 31 is the crowd losing discipline, and the moment the crowd loses discipline, you want a plan that is already written.